Imagine a titan of accounting, trusted by giants, reduced to rubble by one shadowy client. One client that promised endless riches but delivered total annihilation. This is the untold saga of Arthur Andersen, the 90-year-old firm that vanished overnight. Picture Chicago in 1913, a bustling hub of industry and ambition. A young man named Arthur Andersen steps forward, barely 28 years old. Orphaned young, he clawed his way up from mailboy to certified public accountant. He teams up with Clarence Delaney to launch Andersen, Delaney and Company. Their first big win, auditing Joseph Schlitz Brewing Company in Milwaukee. By 1918, Delaney bows out and it becomes Arthur Andersen and Company. Arthur preaches integrity like gospel. Think straight, talk straight, always. He turns down shady deals, even firing a railroad client who begged for fudged books. Ooh, that railroad, bankrupt months later, proving Andersen's unyielding moral compass. He builds the first centralized training program for accountants, revolutionizing the field. Offices sprout nationwide. New York, Los Angeles, Kansas City. By the roaring 20s, Andersen audits industrial behemoths, testifies in landmark tax cases like Ford Motor. 1932 brings a test. Auditing Samuel Insull's massive utility empire. Insull's house of cards collapses in the Depression, but Andersen emerges unscathed. Leonard Spacek takes the helm after Arthur's death in 1947. Spacek globalizes the firm, opening international offices in the 50s. Revenues climb from $8 million, then to $130 million by 70s. Partners exceed 1,000. Consulting and IT services explode onto the scene. But whispers of tension grew between auditors and fast-growing consultants. By 1984, consulting revenues surpass traditional audit work dramatically. Audit partners grumble as consultants demand bigger profit shares relentlessly. 1989 sees Andersen and Price Waterhouse flirt with a mega merger. It crumbles over IBM conflicts and clashing cultures, a narrow escape perhaps. Instead, Andersen splits internally. Auditing stays Andersen. Consulting becomes separate. The 90s ignite a profit war. Consultants resent paying tribute to audit side. Andersen Consulting surges ahead, but bitterness festers like an open wound. 2000 marks arbitration. Consultants win freedom but pay $1.2 billion. They rebrand as Accenture on January 1, 2001, thriving ever since. Arthur Andersen keeps the name but loses its golden goose overnight. Now leaner, Andersen doubles down on audits for energy titans and more. Enter Enron, the dazzling energy trader everyone envied in the late 90s. Founded by Kenneth Lay in 1985 from Houston Natural Gas merger, Jeff Skilling joins, pushing mark-to-market accounting for long-term contracts boldly. Enron reports massive revenues, $13.3 billion in 96, skyrocketing. Stock soars from 90 cents to $90 by 2000 peak. Fortune names them America's most innovative company year after year. Analysts swoon, investors pour billions blind to the smoke and mirrors underneath. But how did Andersen snag Enron? As a top energy auditor, it seemed perfect. They pocketed $25 million in audit fees, $27 million in consulting. That's half their Houston office revenue from one client, dangerously intertwined. Conflicts simmer. Auditors sell consulting to keep clients happy. Independence erodes. Earlier scandals hint at trouble. Waste management in the 90s, $1.4 billion fraud. Andersen signs off flawed books. Settles for $7 million fine, reluctantly. Sunbeam, Baptist Foundation, Asia Pulp red flags waved but ignored. By 2000, Andersen employs 85,000 worldwide, $9.3 billion revenue. Big Fire powerhouse, untouchable, until Enron's house ignites. Enron's secret? Special Purpose Entities or SPEs. Hundreds hiding massive debt. Chief Financial Officer Andrew Fastow masterminds Tuco, buying out Kelper's stake slyly. JED partnership stays off books. $405 million earnings restate later. White Wing gobbles Enron assets for $2 billion, backed by Enron stock collateral. Then LGM 1 and 2, Fastow's private partnerships, board waves ethics code. Funded by banks like JP Morgan, they buy Enron's toxic assets quietly. Raptors emerge, 4 SPEs named after Jurassic Park predators, deadlier still. Enron pumps $1.2 billion in stock and notes into Raptors for hedges. When investments tank, Raptors owe Enron $1.1 billion on derivatives. Mark to market books $500 million gain, propping up 2000 earnings. Andersen audits this maze, approves footnotes buried deep in fine print. David Duncan leads Enron team in Houston. Close to Enron execs perilously. Powers Committee later blasts. Andersen failed professional duties utterly. But wait, what if one whistleblower hadn't surfaced? Would it all stay hidden? Sharon Watkins, ex-Andersen auditor turned Enron VP, smells the rot. August 15, 2001, she pens anonymous letter to Lay urgently. I am incredibly nervous. We will implode in accounting scandals, she warns. Lay vows. Review. Hires own law firm Vinson and Elkins Fox, guarding henhouse. Skilling quits June same year after 6 months as CEO, sells 33 million stock. Lay reassumes CEO. Stock plunges from $83 to $20 fast. Bethany McLean questions in Fortune. Is Enron overpriced? Exposing opacity. Short seller Jim Chanos spots weird broadband values. Shorts the stock early. October 16th. Enron restates. 613 million earnings slashed. Liabilities up 628 million. Equity down 1.2 billion. SEC probes suspicious insider deals. Stock craters to $20.65. Fasto confesses 30 million personal gain from LGM to board shamefacedly. October 25th, he is ousted as CFO amid bank loan refusals critically. Panic grips Houston offices shared by Enron and Andersen auditors cheat by jowl. October 23rd, Duncan emails team, follow document retention policy strictly. Tons of paper shredded. 30,000 emails deleted in frenzied 3 days. SEC subpoena hits November 8th. Shredding halts 9th, but too late disastrously. November 8th. Enron admits 586 million income inflation since 97. Dynegi rescue bid fails. December 2nd. Bankruptcy largest ever at 63 billion assets. Employees lose pensions. Billions evaporate. Shareholders sue for 40 billion. Andersen's turn. Justice Department indicts March 15, 2002 for obstruction. Nancy Temple, legal counsel, and Duncan blamed for shred orders explicitly. Firm hemorrhages clients' energy practice carved up by rivals ravenously. Employees dropped from 28,000 US to 10,000 in months. June 15, 2002, guilty verdict on obstruction of justice charge. SEC bars felons from audits. Andersen surrenders licenses. August 31st. 90 days from indictment to death. Partners scatter to Deloitte, KPMG, EY. The resulting revenue data is 9.3 billion gone. Consulting long split as Accenture survives. Supreme Court overturns conviction May 31st, 2005 unanimously. Instructions too vague, no proof of corrupt intent. Chief Justice Rehnquist rules. Too late, firms a husk with 200 staff. No revival possible. WorldCom fraud follows, sealing Andersen's fate even without Enron alone. One client killed the giant. Enron's fraud, Andersen's complicity, shredding finale. Lessons to be learned here are: Sarbanes-Oxley bond bans audit consulting mashups, mandates independence fiercely. Whistleblowers protected, boards oversee closer, penalties skyrocket for fraud. Today, Andersen echoes in Accenture's billions. Productivity's risk consulting. Andersen tax revives name in 2014 by ex-partners shrewdly, but the original one? A cautionary ghost haunting boardrooms eternally. Imagine trusting your watchdog, only for it to join the wolves mid-hunt. That's Arthur Andersen's tragedy, felled by Enron's venomous embrace. Next time you hear Big Four, remember the fifth that vanished dramatically. What firm teeters now on similar cliffs? Stay tuned for more business downfalls.